This video presents the content in the four primary financial statements. That is the balance sheet, the statement of cash flows, the statement of stockholders' equity, and the income statement. What the statements of financial accounting concept say about the financial information that is presented in each of these statements. Before moving on to preparing the financial statements, if you've already got a good grasp of what's contained in the four financial statements, you can move on to the video on part 3 of the accounting cycle. The statements of financial accounting concepts presents from a big theoretical picture what we account for and how we account for it. The sixth concept statement describes the information that should be contained in the accounting statements. And this information should come as no surprise. It's the information relayed through the two fundamental accounting equations. The first presents the balance sheet information, which is the true fundamental accounting equation. Assets equal liabilities plus equity, where assets are the probable future economic benefits to be received by the company. Liabilities are probable future outflows or sacrifices of economic benefits. And equity is the difference between the two. The initial transaction comes from the owner investing in the company or owners investing in the company. And the balance comes from performing operations and reinvesting those profits in the business. The second statement deals with what I call the magic equation in accounting. Revenue minus expenses, as well as gains and losses, presents net income, where revenues and expenses are inflows and outflows arising from the course and scope of usual operations, and gains and losses are increases and decreases in the business resulting from abnormal transactions, things that don't normally arise in the course and scope of doing business. The accounting statements are interrelated because of these two relationships. For each year, we present a balance sheet, which looks at the transaction at a given point in time, and it's followed up by the end of period balance sheet. When you look at a company's corporate statements, you'll see the beginning of the year and the end of the year positions. They're joined by these flow statements, the statement of cash flows, the statement of stockholders' equity, and the income statement, which show the results of operations, how monies flow through the business over a given period of time. The results of the income statement feed into the balance sheet as retained earnings. The statement of stockholders' equity feeds into the balance sheet, again, as retained earnings and changes in the owner's investment account. And the statement of cash flows shows where the money is coming in and how the money is going out. Let's take a look at these statements in more detail. Examining another one of my favorite publicly traded corporations, Target. The first statement we'll talk about is the balance sheet, which presents that fundamental accounting equation. Assets equal liabilities plus equity. It's a position statement. It shows at a given point in time what the organization is worth. And there's a couple of key components that you should take note of on the balance sheet. First, the cash and cash equivalents. This gets reconciled to the statement of cash flows. Total assets, which should, if you've done everything correctly, balance out to the total liabilities and the total equity. On the bottom half of the balance sheet, you see the total current liabilities, which are any amounts due within the current year, the non-current liabilities, and the total shareholder and liabilities This ties to the assets. Related to this are the shareholders' investment subcategory accounts. These get reconciled on the statement of retained earnings or the statement of equity. So going back to the statement of cash flows, it presents the activities of a business related to operating, investing, or buying new equipment, and financing the business. Now let's take a look at this in a little bit more detail. The operating cash flows shows the cash generated through the ordinary business function. For Starbucks, this is through selling cups of coffee. For Target, this is through selling goods that you sometimes need and sometimes don't need. The second category is investing cash flows. This could be positive or negative, whether you're spending money to acquire new assets or receiving money from selling those assets. And they can mean capital assets like stocks or property, plant, and equipment. The third category is the financing activities. This shows the cash generated or expended through acquiring funding, usually either capital, so stock, or debt, bonds. Composite, we end up with this cash from operations. So let's check your comprehension really quickly and look at the different type of business activities that are described by the cash transactions. The first one, repay a loan from the bank. This is an example of a financing equation. You acquired money for the business through a loan, and now money is going out of your bank account to repay that loan. Number two, selling merchandise from a storefront operation. That would obviously be an operating expense. Good old Target. Third, dispose of an old delivery truck. This would be an example of an investing activity. Unless you're in the business of buying and selling delivery trucks, in which case it would be an operating expense. For someone like Target, who's in the business of selling consumer goods, though, disposing of an old delivery truck would be an investing activity. Paying rent on a company warehouse is an ordinary transaction arising from the course and scope of doing business, so it's an operating expense. Repurchasing shares of stock from shareholders is an example of a financing activity because it pertains to that equity account. And finally, paying utilities is an example of an operating expense. The third statement we'll talk about is the income statement, and that shows what I call the magic equation for accounting, how you get income. It's a sum of the revenue and expenses, as well as the gains and losses that don't occur in the normal course and scope of doing business. The net earnings from the income statement flow into the statement of changes in equity, which we can see for years 2017, 2018, and 2019, and the yellow highlighted rows there. The statement of changes in equity provides a reconciliation of the income statement accounts highlighted here that eventually make their way into the balance sheet, reflected by the fundamental accounting equation. These first three columns, common stock shares, stock par value, and additional paid-in capital, are one component of the equity statement. Retained earnings is another. And accumulated other comprehensive loss and income, that's a separate category altogether, but it also appears on the balance sheet. Now let's do a thought exercise to evaluate which statements are represented. And remember, because of the way that the four statements interact with each other, Each statement may be represented once or 4 times or anywhere in between. Now the first one, accounts payable, that's an account. It's a ledger account, and the only place where you would see it is the balance sheet. So let's look at one that's a little bit harder. Cash received from the sale of equipment. This transaction or category impacts all 4 of the statements. Now let's take a look at each one. The statement of cash flows is an easy one. The cash received from the sale of equipment is an investing activity. To the extent that we're collecting cash and writing off an asset from our business, the balance sheet would also be impacted by this transaction. If we're receiving money and recording either a gain or a loss on the sale, then the income statement would be represented as well. And because the income statement is represented, the net difference between revenues and expenses and gains and losses flows to the statement of changes in owner's equity. Ooh. Let's look at the next one, the net loss. This is another one that impacts all of the statements. The net loss is the converse to net income. It's what you would report on the income statement when you have more expenses or losses than you do revenue or gains. We know that what gets reported on the income statement flows through to the statement of changes in owner's equity. And the statement of changes in owner's equity, which presents the change in retained earnings, would flow through to the balance sheet. But how is the statement of cash flows impacted? Net loss isn't a cash-based transaction. Well, there's 2 methods to computing the statement of cash flows. And the second of the 2 methods begins with the net income or net loss and reconciles the cash and non-cash transactions to that number. So it's kind of a stretch to say that the statement of cash flows is impacted, but it is. Number 4, cash invested in the business. This transaction represents 3 of the 4 statements. It's a balance sheet transaction because cash is coming into the business in the form of an owner investment. Likewise, this would hit the statement of cash flows as a financing activity. And since it's cash coming into the business from the owners, it would hit the statement of changes in owner's equity, that last column. It would not hit the income statement because it's strictly an investment or equity transaction. It's not an income or loss transaction. Number 5, notes receivable. This is an easy one. The only place on which the liabilities appear is the balance sheet. Number 6, rent expense. Again, this one hits at least 3, and it might hit the 4th statement eventually. Rent expense is an ordinary expense that rises through doing business. So obviously it shows up on the income statement as a gain. It shows up as the net impact of results on the statement of changes in owner's equity when you roll that up into the retained earnings. And when the retained earnings get dumped into the balance sheet, it also creates a balance sheet transaction. And again, if you're using the indirect method to prepare your statement of cash flows, then it would also impact that statement. Number 4, building. Without any other information, we assume that this is just the amount represented to show the value of the building on our financial statements. So that transaction hits only the balance sheet. Likewise, knowing nothing else about inventory, we're going to assume that our inventory expense our inventory relates only to that amount reported on the balance sheet, not to the usage of inventory through the cost of goods sold account or the income related therein.